Hey guys, how are you? Yishai Breslauer here, and welcome to the simplest, coolest, funnest explanation of what is IRR. What in the world is this word that gets everybody puzzled? I'm going to make this puzzled face that everybody makes when they got the IRR. Okay, they make this face and they say, what in the world is, I don't understand what it is, I want to understand. And the story goes that a few years ago, I remember, I got into commercial real estate. One of the first things I saw that people tell me IRR, I couldn't understand. I felt so embarrassed. And I need to gain the confidence. There was no video like this one to explain to me in different words what it is. Obviously, I got into it. I dwelled into it. I studied it. I got to learn the formulas, etc., and got to learn pro formas, and got into real estate investment banking, and then I became a CEO of a development and investment company. But regardless, the first thing was a simple explanation. What is it? Nobody could really explain to me. I had to do it on my own. And this video is to compensate for that time. I did not have to come and explain to me in simple words. I'm coming to you and do that. Okay? And years ago, I have a friend who is a developer. And when he was starting up, he called me, Yishai, I need your help. I said, what happened? He said, what in the world is IRR? I don't understand. I said, what happened? I had an investment. He told me a story about an investor that came to him. You know, this one-time investor that everybody wants, who was willing to put tons of capital with him. And he said to him, here's the deal. And the guy got excited. And then in the end, he asked him, okay, what's the IRR on the deal? And my friend's telling him, what in the world is IRR? So the guy said, if you're a commercial real estate guy and you don't know what IRR is, sayonara, and he left. So my friend told me, I got to know what IRR in order to be able to explain that to investors who are coming next, and I did. And I wanted just to show you how to do it. This is not an analyst guy. This is not a pro forma tutorial to understand how a financial analyst should do IRR. No, it's the simplest way for you, because people ask me are wannabes to be, meaning they're entrepreneurs wannabes, developers, maybe operators, they want to be CEOs in this business. They want to get from that capacity, and they first want to know what is it. And the story starts with Charlie with a happy face and a funny hat, and he buys a property for $10 million. The bank gave him $7 million. So he has to come with out of pocket $3 million, what we call equity. That is the story, okay? Don't pay attention to my handwriting. The board is moving. Doesn't matter. $3 million equity he had to come up with. So we have what we call year zero, which is usually the point of acquisition. The point of acquisition of the property, that's what we call it, year zero. And year one is the end of that year. So in the point of acquisition, we had a minus $3 million. And end of year one, I have notes around me, is minus $155,000 because he had renovations and all kind of stuff to add. In the year two, he already was positive and he got $267,500. And year three, things got a lot better to $300,000. Okay? This, by the way, is what we call the net income in our fake deal. Okay? Because you have the revenues from rent, and then you have operating expenses, and then you have net operating income. I'm not teaching about this now, but NOI is net operating income, which is what is the bottom line from that part, meaning taking the revenues, subtracting the operating expenses, etc. And then you have the debt service, right? The debt service to pay the bank the mortgage. So after that is the net income, which in our fake deal is here, okay? So in the year four, okay? In year four, it was $365,000. And year five, something spectacular happened, even though the net income came down to 300. Charlie sold to Bob with a cowboy hat. He sold him the whole property for almost double, 10 million to 19 million dollars. Of course, he had to pay the bank. In real life, you have to subtract all these, principles that he paid with the interest over time. Maybe it's 5 million, maybe it's 6 million, maybe it's 6.5. We make it simple now. Let's say it's $7 million back to the bank, okay? And here, like a balloon loan, whatever. So the bottom line is $12 million to Charlie. What an amazing exit he made. And now we have to calculate the bottom line, which is 12,300,000 in the last year. And every year it's, of course, 365 in here. And here it's 300. And here it's 267,500. And here it's minus 155,000. And here is, of course, the $3 million that Charlie put as an equity in the property. And beautiful. And that's what we do. Now, if we want to understand what is the yield, and a lot of people make that mistake, and they say, okay, and they say, I look at this year, $300,000 in year 3, and they take it up. I'm going to erase this top to give me some room here. I'm going to erase Bob. I hope you respect me. Hopefully we'll not be as confused anymore soon, okay? But we say $300,000 that year divided by the $3 million that Charlie put. It's obviously, everybody knows, it's a 10% yield. What is this thing? It's called cash on cash. Okay? That is cash on cash, COC, because we take the net income on the equity, of course, net income that gets to Charlie. We divide it by his equity, what he put into the deal. It's a 10% he got for year 3. This is not IRR at all, okay? A lot of people come and make that mistake and they think, okay, and they start making a different type of a thing, okay? I'm going to erase this and explain to you now what IRR does. First, before we do that, just a quick explanation. If let's say I have $100,000 and I don't know where to invest, and I choose to take these $100,000 and put them in the mattress, I go to sleep for 10 years, meaning they go to sleep for 10 years. I come up with them again after 10 years and I say, I want to buy the cool stuff I wanted to buy 10 years ago. Wrong, I can't. Because the value of money decreased. If you were born in the early 1900s, and you had $100,000 and you all of a sudden moved to the future. Now, there's a movie about it right now. And all of a sudden you come out with it, bam, you can't do much with it anymore. It's not worth much. IRR takes into the consideration the loss of the value of money over time, as well as discount rates, all kinds of things that could happen with the property, maybe that you have to project that could happen, depreciation, all kinds of things that you don't need to know right now, but all kind of stuff that IRR takes into consideration, okay? But let's say you have a different type of property when you want to invest. You have an office building, you have another multifamily, and another multifamily, and maybe your broker tells you CDs and mutual funds and whatever. And you take all these and you have to compare what they will make you over time. And per year, per annum. So you care about the per annum, sort of an average. It's not an average, it's not an average, but it's sort of an average to know what I make per year over all these mishmash and craziness and confusion that happen over time. In the end of the day, what am I making per year with all this? Taking all these into consideration, my expense, the loss, the growth, the amazing exit, and so on and so forth, it's called IRR. In our case, the IRR is 35%. Very simple formula in the Excel. If you open the box, you say equal, you do IRR, you open parentheses, you drag all these guys together, and then you press enter, you put all these guys together, you press enter, you get this IRR. Okay? Now, very important to understand that IRR takes into consideration all these things. And let's say, for example, that the sale was lower, the IRR would be lower. However, and this is something you need to understand about IRR. If let's say, for example, the sale was much lower, but I made a refinancing here or here, whatever, this year, okay? And then I took this refinancing, which brought me back equity. Let's say I got back after the refinance, let's say I got 2.5 million back home, and then the exit was not as spectacular, the IRR will be possibly higher. Why? It depends on numbers, of course, but the concept is the more money I have up front earlier, the more I can do with it because I can go and invest in other things and even double. The IRR takes into consideration all these events. So when you look at different deals, this deal could be great as a development deal, but this deal could be great because of the refinancing. Put the number, IRR does your calculation. It tells you over time, the internal rate of return. It's hard to say it sometimes, internal rate of return. What will it be and how will it benefit me and how one deal differentiates from the other? Which deal is more sexy? Which one is more fun? Which one makes me more money? Which one is more exciting? And which one over 10 or 15 or 20 years or 3 years or 5 years, whatever I look into my investment to be, meaning if it's a short-term, long-term, mid-term, whatever it is, how much am I going to make? I hope this explanation shed some light on this confusing topic of IRR. You can definitely go ahead and learn more about it and understand more about formulas. You can check out my course also, about commercial real estate for beginners. But basically, this is the basic explanation, guys. Enjoy it. Hey guys, so sorry to interrupt. This amazing video of that guy in the video. I guess he's awesome. But I want to show you here in the Excel something. So sorry to interrupt. We're going to do it very, very quickly. I thought this will be giving you the best value that I could give you because this will shed unbelievable light. Let's get into it. So you see the Excel over there. Here's the IRR, right? How is it calculated? Let's do it again. Equals, right? IRR, open parentheses. I drag all these guys. As I said, I press enter, just like a good boy. I'm pressing enter, guys. Enter. Pooh! 35. 35% a year IRR. This is awesome. When you hear the word 35 IRR, it's obviously per year, but that gives you a good idea of what it is. What I explained to you, I'm not going to repeat. Already explained. Awesome stuff. Now I want to show you something cool, amazing, incredible that Excel can do when it comes to IRR. IRR is not that accurate because year 0, year 1, year 2. Look at the dates I put here, okay? And I'm gonna play with it a little bit now, so you guys can get a real cool, vivid explanation, okay? So let's go. First of all, I'm gonna call it X IRR, so I'll know what I'm doing here. I'm going equal. Look at this, equal X IRR, not IRR. Open parentheses, and it asks me here. You see values. It asks me here to take the values. The values are these guys again. I'm choosing them. Then he asks me to put a comma, just like a good boy. I'm putting a comma, and then I go up to the dates, and I'm adding the dates. And soon you'll see how it works. I add the dates, and all I do is press enter. Enter. Bow. Now I put percentage here to make sure. IRR is different, right? IRR is a little different, 36. Now, look at this. Why? Because I made it in December. Now, let's change the date. Let's make the beginning of the year, not in December. Let's make it in blah, 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 blah. Let's think September, okay? Let's put it in September, okay? So, boom, IRR went to 34. Let's make it earlier. Let's say the deal started earlier, meaning I acquired the deal earlier, and I calculate end of every year just the way it is, but the deal started even earlier. Let's say on May, okay? Bow, IRR goes down. Let's say that I want to calculate the deal, okay, on just like the other dates, 11, okay, on November 1st, okay? So I put the 1, bow, 35, didn't change much because 12, 35 didn't change much, but if you see the decimals here, if I open, let's say, the decimals, 1 second. Here, where is it? Here we go. Decimals. You see, they're a little different. Why? Because it's awesome. It's calculating. It tells us, and that is IRR. You guys saw it. Practice on it. All the love. I'll see you hopefully in other videos that I have, courses and stuff that I can provide you. See you guys. Love you.